In 2015, Walgreens was worth $100 billion. By 2024, that number was $8 billion. In less than a decade, America's most trusted pharmacy lost 92% of its value. It closed more than 2,000 stores. It paid nearly $5 billion in legal settlements. Its stock, once a Wall Street darling, became one of the worst performing in the entire S&P 500. This is not a story about a company that made one bad decision. It's a story about a company that made a series of decisions, each one logical in isolation, that combined to destroy it from the inside. Walgreens did not fail because Amazon beat it, though Amazon didn't help. It did not fail because of the opioid crisis, though the opioid crisis cost it billions. It failed because its leadership spent a decade optimizing for the wrong things: financial engineering over pharmacy, expansion over execution, debt over durability. By the time anyone noticed how serious the damage was, it was already done. This is the business autopsy of Walgreens Boots Alliance. Charles R. Walgreens Sr. opened his first pharmacy in Chicago in 1901. He had one idea: make the drugstore a place people actually wanted to spend time in. He added soda fountains. He added lunch counters. He turned a functional errand into a neighborhood destination. By the 1930s, Walgreens was a cultural institution across the American Midwest. By the 1960s, it had expanded coast to coast. For most of its first 100 years, Walgreens was an operator's company. It was run by pharmacists who understood what a pharmacy was for. The store count grew steadily. The balance sheet stayed clean. The business model was simple: fill prescriptions, sell convenience items, keep customers coming back. By 2000, Walgreens had nearly 3,000 locations across the United States. By 2010, that number had grown to 7,700. Prescription volume was rising. Insurance reimbursements were reliable. The model worked. In 2010, Walgreens generated $67 billion in revenue. It was the largest pharmacy chain in the United States. It employed 250,000 people, and it had barely any debt. That was the high point. Most people just didn't know it yet. In 2012, Walgreens made its first major strategic move into the global market. It paid $6.7 billion for a 45% stake in Alliance Boots, a European pharmacy and wholesale business headquartered in Switzerland. The man behind the deal was Pessina, an Italian billionaire who had built Alliance Boots through a series of acquisitions. He was sharp, experienced in deal-making, and had a clear vision for what a global pharmacy empire could look like. In 2014, Walgreens bought the remaining 55% of Alliance Boots for an additional $15 billion. The combined entity became Walgreens Boots Alliance, a global pharmacy giant operating across 25 countries. The acquisition made Walgreens the largest pharmacy chain in the world by store count. It also loaded the company with debt it had never carried before. But the real problem was not the debt. The real problem was what came next. Pessina became CEO in 2015. His philosophy was financial engineering first. He initiated an aggressive share buyback program. Between 2014 and 2018, Walgreens returned tens of billions to shareholders, while the core business, the actual pharmacies, began to show signs of structural stress. The US pharmacy model was changing in ways that Walgreens was slow to respond to. First, pharmacy benefit managers, the middlemen between drug manufacturers and insurance companies, began squeezing reimbursement rates. The margin on filling a prescription, which had always been thin, got thinner. Walgreens had 9,000 stores and a cost base built for a different era of profitability. Second, Amazon entered the pharmacy space in 2018 with the acquisition of PillPack, a mail-order pharmacy that delivered pre-sorted medications directly to patients' doors. One announcement wiped $11 billion off the combined market cap of Walgreens and CVS in a single day. The threat was existential, and it was not going away. Third, the opioid crisis arrived at Walgreens' door with full legal force. For years, Walgreens pharmacies had dispensed opioid prescriptions at scale, often without adequate safeguards. In 2022, a federal judge ruled that Walgreens, CVS, and Walmart had contributed to the opioid epidemic in 2 Ohio counties. The settlement negotiations that followed produced a bill of nearly $5 billion for Walgreens alone. That is $5 billion that did not go into store investment, technology, or people. It went to lawyers and governments. Then came the retail pharmacy death spiral. With margins compressed, opioid liabilities mounting, and online competition growing, Walgreens needed to cut costs. It announced it would close 2,150 stores, roughly 25% of its US footprint, over a 3-year period beginning in 2024. The store closures made financial sense on paper. Each closure saved a lease, a payroll, a set of operating costs. But each closure also removed a customer touchpoint that had taken decades to build. And it signaled to the market something that was very hard to unsay. We built too many stores, and we cannot afford to run them. Walgreens stock, which had traded above 100 in 2015, fell below $10 in 2024. The company that had once been a blue-chip S&P 500 anchor was removed from the Dow Jones Industrial Average in 2018, replaced by Walgreens' rival, a sign of just how far the reversal had gone. In 2024, Walgreens reported a net loss of $8.6 billion in a single financial year. That is not a bad quarter. That is a structural implosion. Timothy Wentworth, who replaced Pessina as CEO in late 2023, inherited a balance sheet carrying $8 billion in long-term debt, a pharmacy reimbursement model that was broken, a workforce demoralized by years of cost-cutting, and a store network actively being dismantled. Wentworth's plan was brutal in its honesty: shrink, stabilize, and survive. Close the worst-performing stores. Focus on healthcare services. Walgreens had made a massive bet on Village Medical, a primary care provider it acquired for $5.2 billion, also now being wound back. Try to turn the pharmacy into something more than a prescription counter. The Village Medical acquisition is worth pausing on. It represented Walgreens' attempt to pivot into healthcare services, the idea being that combining a pharmacy with an in-store clinic would capture more of the patient relationship and higher margin revenue. The execution was poor. Village Medical burned cash. Walgreens wrote down billions. By early 2025, reports emerged that Walgreens was in discussions about going private, potentially with private equity firm Sycamore Partners. The discussions centered on a deal that would take the company off the public markets entirely, removing it from the scrutiny of quarterly earnings and allowing it to restructure without the market watching every move. Whether that deal closes or not, the message is the same. Walgreens as a public company is no longer viable in its current form. A company founded in 1901, 120 years of building trust with American families. A brand as embedded in the American streetscape as the post office or the petrol station, being quietly taken apart. The mental model from the Walgreens collapse is what I call the incumbent's trap. The incumbent's trap works like this. A company dominates its market for so long that it begins to confuse scale with strength. It has thousands of locations, millions of customers, decades of brand equity. It looks unassailable. That scale becomes the trap, because maintaining it requires enormous capital. And when the economics of the business shift, when margins compress, when competitors find a cheaper model, when litigation arrives, that scale becomes a liability instead of an asset. Walgreens could not pivot quickly because it had 9,000 stores. It could not cut costs without destroying the network. It could not rebuild the model without admitting the old one was broken. Every decision was made harder by the weight of what had been built. The lesson for every business leader watching: size is not a moat. It is often the opposite. The largest player in a market is frequently the most exposed when that market changes, because they have the most to lose, the most to protect, and the least flexibility to move. Amazon had no pharmacies in 2018. That was not a weakness, it was freedom. Walgreens had 9,000. That was not strength, it was inertia. The signs were visible for years: in the margin compression, in the opioid settlements, in the Amazon acquisition of PillPack, in the debt load, in the store count that kept growing past the point of rational justification. Every failure leaves evidence. In Walgreens' case, the evidence was sitting on the balance sheet for a decade before the market finally read it. We examine it so you can recognize it in your industry, in your competitors, in your own organization before it is too late. Every failure leaves evidence. We examine it. Subscribe.